Corporate governance refers to the system by which organizations are directed, controlled, and held accountable. It establishes the framework of relationships among shareholders, directors, management, regulators, and other stakeholders. The need for corporate governance regulations emerged from concerns that management may not always act in the best interests of shareholders and other stakeholders. High-profile corporate failures and accounting scandals demonstrated that weak governance structures can lead to fraud, financial misstatements, excessive risk-taking, and destruction of shareholder value. Effective governance regulations help safeguard investor interests, promote accountability, and ensure that organizations operate in a transparent and ethical manner. One of the primary reasons for corporate governance regulation is the separation of ownership and control that exists in many modern corporations. Shareholders provide capital and own the organization, while directors and managers are responsible for day-to-day operations. This separation can create agency problems where managers pursue personal objectives rather than maximizing shareholder value. Corporate governance regulations seek to reduce these conflicts by establishing clear responsibilities, monitoring mechanisms, and reporting requirements. Through oversight by boards of directors, audit committees, and independent auditors, governance frameworks encourage management to act responsibly and align decisions with the interests of investors and other stakeholders. The scope of corporate governance regulations extends beyond financial reporting and encompasses the overall system of organizational control. Governance frameworks address board composition, director responsibilities, executive remuneration, risk management, internal controls, accountability, ethics, and stakeholder relationships. Regulations also define the role of audit committees, external auditors, and disclosure requirements. By covering these areas, governance systems help ensure that organizations are managed effectively and that risks are identified and controlled. Strong governance contributes to sustainable value creation by improving decision-making processes, strengthening oversight, and promoting confidence among investors, lenders, employees, customers, and regulators. Corporate governance regulations are also necessary to support the integrity of financial reporting. Investors and creditors rely on financial statements when making economic decisions, and confidence in reported information is essential for efficient capital markets. Governance mechanisms such as independent audit committees, robust internal controls, and external audits provide assurance that financial statements are prepared fairly and in accordance with applicable standards. The failure of governance arrangements in major corporate scandals demonstrated that inaccurate financial reporting can mislead stakeholders and undermine market confidence. Consequently, governance regulations seek to improve transparency, reliability, and accountability in financial reporting processes. Different countries have adopted varying approaches to corporate governance regulation based on their legal systems, market structures, and cultural traditions. One common approach is the rules-based model, which relies on detailed legislation and mandatory requirements. Organizations must comply with specific governance provisions prescribed by law or regulatory authorities. This approach provides clarity and consistency, making it easier to enforce compliance. However, detailed rules may encourage organizations to focus on meeting minimum legal requirements rather than embracing the underlying principles of good governance. Rules-based systems can also become complex and less adaptable to changing business environments. An alternative approach is the principles-based model, often referred to as the comply or explain approach. Under this system, organizations are expected to follow broad governance principles and best practices but may depart from specific recommendations if they provide a satisfactory explanation to stakeholders. This approach emphasizes flexibility and encourages organizations to apply governance arrangements that reflect their particular circumstances. Rather than focusing solely on technical compliance, principles-based regulation promotes consideration of the spirit and objectives of governance requirements. However, it depends heavily on transparency, stakeholder scrutiny, and the willingness of organizations to provide meaningful explanations for deviations. Many governance frameworks combine elements of both rules-based and principles-based approaches. For example, legal requirements may establish minimum standards for board structures, financial reporting, and auditing, while governance codes provide broader principles and recommended practices. This hybrid approach aims to balance consistency and flexibility. Mandatory requirements ensure a baseline level of protection for investors and stakeholders, while principles-based guidance allows organizations to adapt governance practices to their size, complexity, and operating environment. Such a combination seeks to encourage both compliance and genuine commitment to effective governance throughout the organization. In summary, corporate governance regulations play a vital role in promoting accountability, transparency, and responsible management within organizations. They address the challenges arising from the separation of ownership and control, support the integrity of financial reporting, and help protect stakeholder interests. The scope of governance extends across board oversight, risk management, internal controls, auditing, ethics, and disclosure. Different jurisdictions adopt rules-based, principles-based, or hybrid approaches depending on their regulatory traditions and market needs. Regardless of the specific model employed, effective corporate governance contributes to organizational sustainability, investor confidence, and the efficient functioning of capital markets.